US $40.05 trillion debt crisis. Strengthen your fiscal strategy. The US $40.05 trillion debt crisis urges you to strengthen your fiscal strategy and defend capital value. The US debt has crossed $40.05 trillion, but you should look beyond the headline. Borrowing, interest costs, and shrinking policy flexibility create the real strategic threat today. Debt climbed from $38 trillion in October 2025 to $39 trillion in March and above $40.05 trillion in August 2026, exposing an accelerating fiscal trajectory. CBO projects a $1.9 trillion fiscal 2026 deficit, rising from 5.8% of GDP in 2026 to 6.7% by 2036, despite avoiding traditional recession conditions. Net interest could rise from approximately $1 trillion in 2026 to $2.1 trillion in 2036, with cumulative decade payments potentially reaching $16.2 trillion, severely limiting flexibility. The 30-year Treasury yield hit 5.34% on August 19, a 19-year high, while Treasury doubled planned long bond buybacks from $2 billion to at least $4 billion. The effective federal funds rate stood at 3.63% on August 18, while July meeting minutes indicated some policymakers considered further increases if inflation remained persistently elevated. For your business, higher Treasury yields can transmit into corporate bonds, bank loans, mortgages, and investment hurdles, making debt-funded expansion harder to justify economically and strategically. Impact Solutions frames the $40.05 trillion milestone as governance failure involving debt growth, persistent deficits, interest rates, mandatory spending, and shrinking fiscal flexibility across government. At $40.05 trillion, a 1% increase in average borrowing costs could add roughly $400 billion annually, while nominal GDP growth of 3.5% to 4.0% faces mounting interest pressure. CBO expects real GDP growth to slow from 2.4% in 2026 toward 1.8% annually thereafter, while net interest rises from 3.3% to 4.6% of GDP. Mandatory programs represent approximately 60% of federal outlays, while Social Security spending could increase by $300 to $400 billion annually. Even a 1 percentage point tax rate increase faces resistance. Our analysis rejects easy growth optimism. Sustaining 3% real GDP growth would require roughly 2% productivity growth, versus current productivity trends closer to 1% to 1.5%, making stabilization difficult. Immediate sovereign default is not central because Treasury liquidity exceeds $30 trillion and the dollar represents about 58% of global reserves. Crowding out is the more material risk. Annual net new Treasury supply exceeds $1.5 trillion, while debt held by the public could approach 120% to 130% of GDP, increasing real yields and compressing equity risk premiums. The planned $83 billion bond repurchase program represents less than 0.3% of marketable debt, so even tenfold expansion cannot offset annual deficit accumulation above $1.8 to $2 trillion. Companies should stress test benchmark rates at plus 100, plus 200, and plus 300 basis points, linking potential interest expense increases of 10% to 30% to EBITDA, coverage ratios, and valuation compression. Refinancing risk rises when 40% to 50% of debt matures within 24 months. Extending weighted average maturity to 5 to 7 years and maintaining 36-month visibility materially improves resilience. Liquidity should cover 6 to 12 months of fixed operating costs, with 1.5x covenant headroom. Reducing the cash conversion cycle by 10 to 20 days can free 2% to 5% revenue. Capital allocation must adapt. Projects clearing a 10% hurdle may fail at 11.5% to 12.5% WACC, while a 1% discount rate increase can reduce NPV 8% to 15%, demanding discipline. You should monitor coverage below 3.0x, spreads above 250 to 300 bps, leverage above 4.0x EBITDA, 25% debt maturing within 12 months, and quarterly liquidity forecasts. Is your business built to survive $40 trillion in U.S. debt and 5.3% yields? Comment your answer below. For more analyses, visit our consultancy website. Link in description below. Thank you.